When I look at gold acquisitions, again, China doesn't buy gold for no reason. And they've bought 1,000 tons since the start. That's what they tell us, since the start of the Ukrainian war. At the same time, they've sold $250 billion of our U.S. Treasuries. This is a trend that will continue. This de-dollarization will continue. I think they'll continue to accumulate gold rather than try to devalue their yuan against the dollar. They'll let it happen organically by accumulating gold. I think that's something certainly to focus on. Of course, it's the bond market. At the same time, I think the bond market, or with the Fed creating trillions to fund these deficits, that not only that they're inheriting, but the debt that is coming due. I think the bond market's getting very nervous that they see inflation coming back, that the ballooning U.S. debt is something that has to be dealt with, and how many Treasury securities will have to be created.
China has strategically shifted its financial holdings, purchasing 1,000 tons of gold since the start of the Ukraine war, while selling $250 billion in U.S. Treasuries. This trend reflects a broader move towards de-dollarization. Instead of devaluing the yuan against the dollar, China is likely allowing its currency to adjust naturally by accumulating gold reserves. Meanwhile, the U.S. bond market is under pressure due to inflation concerns, rising debt, and the Federal Reserve's need to create trillions to manage deficits and maturing debt. Traditional foreign buyers of U.S. debt are increasingly moving away, exacerbating the challenges. Bill Holter, a respected financial analyst and commentator, explains Warren Buffett has historically raised cash during market bubbles, such as before the 2000 dot-com crash and the 2008 financial crisis. Currently, Berkshire Hathaway is holding $145 billion in cash, the most significant amount ever, reflecting Buffett's belief that no good value investments are available. However, this cash strategy may backfire if a credit event occurs, as traditional safe havens like sovereign debt may prove unreliable. In such scenarios, historical stores of real value, gold and silver might outperform cash and sovereign securities, mainly if downgrades or collapses occur. However, Alistair MacLeod, a seasoned economist, market strategist, and advocate for sound money principles, exposes that the above-ground stock of gold has grown steadily, aligning with global population growth and maintaining gold's purchasing power. Gold remains stable, unlike fiat currencies, which consistently lose value due to monetary inflation and declining trust. Recently, gold prices have risen by 27%, signaling a loss of faith in the dollar, which has dropped a quarter of its value against gold despite only a 3% increase in money supply. While the dollar appears strong compared to weaker currencies, its value is declining against gold. Rising bond yields are expected to destabilize capital markets further, making gold a critical asset in an era of eroding currency trust. Let's explore the video in more detail. If you find this content helpful, give it a thumbs up and subscribe to stay updated with our latest videos.
Warren Buffett. Warren Buffett, I mean, I can remember back in 1998, 99, people were saying, you know, Warren Buffett's washed up because he wasn't buying the dot-coms. He was raising cash. He had a huge amount of cash going into 2000, 2001. And of course, the market cracked. Same thing happened again in 2007, 2008. He was raising cash. And he now, I think the number's 145 billion in cash is what he's sitting on. And that is the largest amount of cash outright, and the largest amount as a percentage that that Berkshire has ever held. So the reasoning behind him raising cash, and I mean, he says this himself, is that he can't find anything of value or of good value to purchase. So cash is a better place to sit. Now, I do believe that when this does go down, Warren Buffett is going to find out that he's sitting on the wrong type of cash, because ultimately gold and silver, they are real monies. And historically, you went to cash for safety. And if you've got a credit event happening, how safe are some of these sovereign debt securities going to be? I think we're going to find out that, not everything's AAA rated, not everything's safe. And we're going to find a bunch of sovereigns that get discounted and downgraded, maybe even completely collapse.
I mean, the growth of above ground stocks has more or less kept pace with global population, averaging around about sort of 1.5%, 2% per annum. So it's not surprising that, there is a balance, if you like, in the whole thing, which means that the purchasing power of gold remains constant. All the other fiat crap, it just basically loses it and loses it and loses it. And it loses it. I mean, normally it's an interesting one because the monetarists, they do understand the dilution, if you like, of purchasing power of a currency, which they call monetary inflation. That's one aspect of it. But the other aspect, which they haven't really grasped, is that it actually depends. The value of a currency depends on the faith in it. And it's that faith which is now being eroded. This is why I mentioned 27% increase in the price of gold, or put another way, the dollar in gold has lost a quarter of its value in the last year, whereas money supplies only increased 3%. What's that telling us? It's telling us that the dollar is actually on a very slippery slope. But the thing that's, sort of surprising in a way to some people is that the dollar is the strongest currency. I mean, you look at the trade weighted, look at the chart of it. It's got a golden cross under it. Dollar's going up. Yeah, of course it's going up because all the other rubbish is even worse. So, but measured in gold, I mean, here I am in the UK and we've got a new socialist government. Nobody here has really bought gold, but it's the one thing to have because sterling's going to go down against the dollar's going to go down against gold, interest rates, or rather bond yields, are going to rise, which is going to destroy capital markets completely.
In a live interview at Liberty and Finance, McLeod points out that banks are currently trying to de-risk their balance sheets due to excessive leverage accumulated during the era of suppressed and negative interest rates. This leverage, exceptionally high in regions like Japan and the Eurozone, resulted from banks responding to ultra-low rates. With higher interest rates, banks are shifting credit from the private sector to government securities, especially short-term Treasury bills, to reduce risk, undermining productive economic activity and inflating government-driven GDP figures, which are misleadingly optimistic but ultimately inflationary. Moreover, as bond yields rise, particularly the 10-year yield, which is expected to surpass 5% in early 2025, the financial system faces significant stress. Businesses and banks with excessive leverage will struggle, leading to defaults and potential failures. Historical parallels, such as the 1930s, show widespread bankruptcies and bank failures can sharply contract credit. This looming scenario suggests a challenging environment for the private sector and the banking system in the coming year. Now, let's shift our attention towards the interview.
Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money. So the point is that you have the entire system trying to de-risk itself, not by, in aggregate, reducing its overall level of credit, but by, if you like, taking funds away from the private sector and applying them to government, and specifically applying them to government through the T-bill market rather than longer-term maturities. That's the way in which the banking system de-risks itself. The problem with that, obviously, is that it kills the private sector. And, Bill made the point earlier about, the falsity of the GDP numbers, because so much of it is actually the expansion of government credit, which is it's inflationary. It's not credit aimed at production in any sense. Production in the sense that the private sector is producing something that people actually want, that they will actually demand. No, this is credit which is produced by a government which says, you will have this, you will have that. Now, this is inflationary. So this is the background against which the banking system operates. The first is businesses go bust. And I think we're going to see quite a lot of that in 2025. And the second is that banks go bust. If you look at what happened in the 1930s, when money supply contracted by something like 40%, it weren't because the credit was sort of, if you like, being, contracted by the banks. No, it was because banks were going bust and businesses were going bust. When an obligation is no longer available, the credit on the other side disappears. It's completely worthless. So the point about this is that in 2025, as bond yields rise, and particularly the 10-year, we'll see that go through 5%, I think probably in the first quarter of this coming year. If that happens, and I think it will, then you'll find that banks and businesses will be getting into trouble.
The global financial landscape is undergoing significant shifts as rising interest rates, excessive leverage, and de-dollarization trends challenge traditional economic structures. Gold continues to emerge as a reliable store of value amidst declining trust in fiat currencies, while banks and businesses face increasing risks from mounting debt and tightening credit conditions. These developments highlight the importance of understanding the interplay between monetary policies, market dynamics, and economic resilience. How can individuals and businesses best prepare for potential credit contraction and rising bond yields in 2025? What role will gold and other tangible assets play in safeguarding wealth as trust in fiat currencies declines? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.